So next, I'd like to introduce to you guys Jordan Levine. He's the Senior Vice President and Chief Economist for the California Association of Realtors. We all know who C.A.R. is, right? It is a statewide trade organization of real estate professionals with whom has more than 200,000 members. Jordan is responsible for C.A.R.'s housing market and economic research, as well as policy analysis for C.A.R.'s legislative and governmental affairs effort. He has a passion for homeownership, fair housing, housing supply, and regularly represents C.A.R. to its members, industry group, policymakers, and in media. There it is, Jordan.
Good morning. Thank you for having me back. I always love coming to Bakersfield. You guys are super close to me, so it's easy. But you guys are also seems like a big family. You know, every association I go to, it doesn't have the family vibe where everybody's hanging out. I saw all your past presidents working the room, all my homies, and I didn't even have a chance to say hi because they're so busy talking to all of you. So you have amazing leaders, and yeah. You got an amazing AE, too. I don't know why I'm bigging up your association, but I love your AE. I nerd out with him. I feel like he's my taller, smarter, better-looking younger brother that has more hair. But, yeah, we're kindred spirits, and I took up about an hour of his time yesterday nerding out on some of your guys' MLS data, which hopefully you guys will benefit from, too, in addition to me just kind of enjoying it, too. But terrible time to be a forecaster, though, be totally honest with you. The market's all over the map. The bond market's all over the map. The one thing that has happened is the economy has done more or less what I said it was going to do last year, but kind of how everybody reacted to that, unfortunately, was pretty turbulent. So actually, we finally got the rate cuts. You might not have even noticed the second one, but I think my number one piece of advice that I've been giving for the last 2 years is borne out by our experience the last 6 months, because you've had a lot of people still waiting on the sidelines, still drinking the Kool-Aid on a market collapse that was imminent, waiting for the Fed to start cutting rates. And actually, if you go back to late July, early August, you could have got a mortgage for about 6%, maybe even better than that, depending on how motivated that seller was. And, they're well, we're going to wait for the rate cuts in September, right? We're going to wait for the election. We're going to wait for the second rate cut in November. And this has kind of been the tail of the tape, right? Rates were lower before the Fed made their first rate cut, because we all kind of forgot that the Fed doesn't control mortgage rates, that the Fed sets the risk-free rate of borrowing. There's private sector risk and time value of money on top of that, meaning that it's not what the Fed does, it's what the bond market does that matters for us in real estate. And guess what? The bond market isn't sitting around waiting for the Fed to act. They're operating in advance on the basis of their expectations, so what they think is going to happen, right? And so when their expectations get violated, when the Fed doesn't cut rates as fast as they wanted or hoped, they pour out of the bond market, rates go back up, and that's why waiting for the Fed, as turbulent as it's been, at its core, my message of stop waiting for rates has been proved correct, because not only have rates not gone down a ton, they've gone up a little bit, but more importantly, prices have continued to go up, right? So you get a Fed rate cut, and then about a week later, you get a pretty big blockbuster jobs number. Fed just gave us 50 basis points. But the bond market freaked out that inflation's going to stay put because of all these jobs, and rates went up 30, 40 basis points, right? Same thing, strong retail sales, all these additional indicators that show the economy's still doing good means the bond market's worried that inflation won't go away as fast as they're hoping. Rates are going up, not down, even though the Fed has delivered on those rate cuts. So stop waiting for rates. All the good stuff you were hoping for is called out on this chart, and you can see what happened every time they delivered on that. It wasn't what you were hoping it was going to be as a home buyer, particularly as prices are a lot higher now. If you would have listened to me 2 years ago, you would have saved a boatload of money, right? Prices haven't tanked, rates haven't come down a lot. You'd have 2 years worth of equity built up. Instead, you're paying 2 years worth of price appreciation higher in your price tag. So you already didn't like the $400,000 house. Now you got to look at the $300,000, right? You're doing yourself a disservice, like listening to whoever your relative of choice is. For me, it's my brother-in-law, right? But everybody's got that uncle, that, father-in-law, the brother, the uncle, whatever. Look at what they've done to you. They haven't helped you. The longer you wait, the harder it is. That's kind of the one thing that we can say with clarity. Rates this morning were back down to 7.05. Last week in the Freddie Mac number, they were 7.08. We might see them go even higher. I don't think they're going to go a ton higher, but they could. The more important point, though, is I don't think they're going to drop precipitously, and we'll talk a little bit about why. But ultimately, the Fed's steady state, long-term, like optimal Fed funds rate is about 2.5% to 3%. So if you're waiting for a 3% mortgage rate, you can't have 3% mortgages when you have a 3% Fed funds rate, unless you're saying that I'm just as sure of a bet as the U.S. government and that you don't care about having your money locked up for 30 years instead of a month or a day, right? Like those things add spreads on top of whatever the Fed does. And so when your brother says wait for 4%, he's in denial or not looking at the chart. So whether they go up or stay flat, the point is they're not going to be 4 or 5% in the next year's time. And guess what? If I'm totally wrong and missed the boat on that, go out and refi when they get to 4%. My bad forecast cost you nothing. Your brother-in-law's bad forecast cost you another $80,000 in purchase price that you're now staring down the barrel of as prices go up another 7, 8, 9, 10%, depending on how long you wait. So waiting for rates, recipe for disaster. Unfortunately, that's what every single person, it seems like, is doing. Like my friend back in SLO is always like, you keep saying the same thing, like stop waiting for rates, stop waiting. It's like because everyone's still like waiting for rates, though. Everyone was waiting for the cuts. They're waiting for the election. We haven't seen a huge increase in mortgage applications. And you can see the orange is the mortgage rate and just how incredibly hypersensitive those mortgage applications are to even minuscule changes in rates. Rates go up 20, 30 basis points. Everybody jumps ship. They come down. Everybody pours back in real quick, right? And we've had this very, very rate-sensitive buyer pool out there of people who are 1 foot in, 1 foot out, waiting for rates, meanwhile forgetting that prices keep going up. And guess what all the other buyers are waiting for? 4% rate. So even if we see a 4% rate, all the other buyers are going to come back. Their brother-in-law is going to say, go for it. Now's the time to go, right? And prices, we're going to transfer all that through to prices, right? And so, again, stop waiting for rates. The other thing I like telling buyers, too, is that rates aren't ever consistently below where they are now, more or less. When I made this chart, rates were 6.8%. That's the 40-year historic average going back to the early 80s. That means, more or less rates are always about where they are right now. And that's like without even including all this crazy stuff in there. I started it just in the 80s, right? Rates now are normal. 3% is not normal, right? The 3% is a one-off blip anomaly that you probably won't see again. And I would argue we should root against never seeing again. We don't want to see that again because the only time you get rates sustained below where they are right now is when there's terrible stuff happening in the economy, right? It happened when the dot-com bubble collapsed in San Francisco and took out the stock market, right? It happened when the housing market collapsed and we had like a 10-year jobsless recovery where people lost half their life savings. By the way, if they would have held those homes, they would now have doubled their life savings. That's another story. But from a rate standpoint, rates don't stay below 6% unless terrible stuff is happening. And so even actually, I didn't call it out here, but if you look between these two little red things, between the end of the housing bubble and the start of COVID, rates were already trending back to 6%. And then the pandemic hit and they went back down. But 6 is more or less the norm. 6 is more or less the average going back in time. The gray stuff on this chart shows you every period in history where rates were as high or higher than they were the day I made this chart. And it's almost all of recorded history, right? Except for during those periods when terrible stuff was happening. Rates now are normal. My dad, I told you, he bought back here when rates were way up here. And he was pumped at a 12% mortgage because he'd be borrowing a lot of money. I wish he was around just to be able to borrow money right now, because he would not be shy about buying more property, because the long-term price appreciation stuff, which I'll show you in a minute, has gone nowhere. The other reason why I think even as a lot of these cyclical issues and very like acute issues that we've been triaging for the last couple of years have gone away, we have new issues like insurance, and we also have our structural issues, which have been left more or less unaddressed. In Boston, insurance was a huge hot topic, and like we've been dealing with this now for a few years and probably are joining Florida on the leading edge of this crisis, but insurance is going to continue to be a big deal moving forward, and I think ultimately it means costs are going to go up. This has real implications for us, and that's why I'm giving you my optimistic view about the market improving and the economy not tanking and all of that stuff with like a healthy dose of realism, because I think the grind is going to become the norm. I kind of think like being a realtor or real estate professional now is kind of like, I don't know, the analogy for me is like when I became a parent, right? And you like first are like overwhelmed and you got these kids and you're like have ramped up to like an 11, right? And you're not sleeping and you're like going crazy and you're like, oh, but like eventually it's going to come back down, right? Like once they're potty trained, once they can put on their own shoes or buckle their own seatbelt and all this stuff, but you like are living in denial that you just live at 11 now, and that's like what it is forever. And like my kids are teenagers, and it's still an 11. But I think like that's kind of the name of the game in real estate going forward. Like, yes, the pandemic's gone. Yes, we don't have the Fed throwing a monkey wrench in anymore. Stuff's kind of going back to normal demographically, migration patterns. Like everybody's not moving out to Mammoth Lakes anymore. All of that kind of stuff, but the housing supply, the insurance, the affordability, right? All of that stuff, including rates that aren't going to drop back down to 4% and prices that are probably going to still stay at these levels that have those super low rates baked into them, means we can't take our foot off the gas. So like on the one hand, yes, we survived. The economy is going to be okay. Rates are going to come down very gradually, right? But like you're going to have to keep it at 11 probably moving forward. I do think that there's an opportunity for rates to continue to creep down though, and this is the stuff I presented back in Long Beach, so little bits happened over the last couple of months since then, but I'll give you my perspective then and then kind of round out with what I might want to tweak moving forward. On the one hand, inflation's going away, right? So a lot of this pandemic shortage-driven inflation, factories are back on, people are back at work, toilet paper is back at Costco, all that stuff. And we're approaching that Fed target of 2.5 or 2%. We're at 2.5 now, but you can see the progress very, very incremental of late. And that's because this last mile's pretty much labor shortage driven. We're at very low levels of unemployment. For some people, they retired early. For other people, childcare costs so much that it doesn't make sense for you to go to work anymore. Like you're net neutral by, flipping burgers all day or watching Price is Right all day, right? Like there's, once you factor in the cost of healthcare. So we have this labor shortage, meaning that wages are going up. That gets passed on to consumers, right? Like my kid's like, can you take me to Taco Bell? I want one of those like tacos with the Dorito shell on it. I was like, okay. We spent $35 at Costco. That's a function of the labor shortage, right? Like you used to have $5, you ate like a king at Costco when I was a kid. I was like, oh my God, $35. But it's because of it's labor market driven, and that's the hardest piece to get away, right? Shortages are easy to cure. You flip the factory back on, you put the toilet paper on the boats and get it into Costco, prices come down. Retirees don't come back to work because rates go up to 8%, right? Like childcare costs don't get cut in half, when there's a super big labor shortage. And so unfortunately, the progress is going to be incremental. It's going to be progress, but it's going to be very incremental. Unemployment's still sub 5%. And so for businesses to grow, which they're doing, and people are still spending money, you can't just pull in like underutilized or idle resources that are just chilling on the sidelines waiting to be roped into the economy, right? For me to grow, it means I got to steal workers from you. And that means I got to pay them more. And that means I got to charge you more. And that means there's no more 59, 79, 99, Taco Bell, all that stuff, right? So moving in the right direction. If you look at the headline numbers, very, very strong. But I think if you kind of scratch the hood of those numbers, there's some reasons to think that it's not as strong as it seems, and why we'll continue to make progress and probably still get more rate cuts next year, and all of that stuff. GDP still growing, though, at a pretty solid clip. It was actually 3% in the third quarter, too. In California, we're starting to lose momentum on the job side, right? So you can see that we've really decelerated from that 20,000 or so job a month pace that we were hanging out at in the kind of post-pandemic era. And we tend to be a leading indicator for the nation as a whole, right? When California sneezes, the rest of the United States catches cold. Probably going to start to see that stuff happen just because we're like 13% of all GDP. If you look in California's numbers in particular, there's more slack than what those headline numbers would suggest. They do two different surveys that you read about in the newspaper when they say, here's what jobs did, here's what unemployment did. The employment numbers, where we continue to add about 20,000 jobs a month outside up to the last few months, is what you get when you call employers, right? So you call me, I say I have 5 people. You call Jeannie, she has 10 people. Add them all up, that's the 20,000 a month, right? They also do a survey of households, and the reason why this distinction is important now is because when you call me and Jeannie, we're not factoring in whether any of those people are the same people, right? So I say 5, she says 10. If 3 of them are working at both jobs, that's actually showing up as more and more job growth, but it's not necessarily a sign of strength when you got a lot of people picking up multiple jobs to make ends meet. That's kind of what you see if you look at the household one. When you call me and say, do I have a job, yes or no, call you, add all those numbers up, the amount of people saying, yes, I have a job has come down. The amount of people that say, no, I don't have a job has gone up, right? And so there is a little bit more weakness than what these top-level economic numbers would have you believe. If you put both those numbers together, that's what we call the labor force. It's the amount of people either working or who want to work and aren't, right? That's the stuff I'm showing you in blue on the right-hand side. The good news is labor force is going up, right? So our labor shortage problem will probably start to go away because we have more and more people coming off the sidelines or finally getting kicked off mom's couch or whatever it is. But I would argue there too, that's kind of like an underlying strength or, sign of weakness, right? That like my credit card bill wasn't big, then I'll just eat the Hot Pockets and stay at mom's, right? But I think things are starting to get so bad with all of this inflation and credit card debt that I'll show you in a minute that people are actually like, I probably got to get a job now, right? And they're starting to look for work again. So yes, it's going to help on the inflation side, but I think, 25 and 26, we're going to remember why economists thought it was bizarre that you root for a weak economy, right? It's like everyone wants the economy to weaken so that inflation goes away and the Fed will cut the rates, but it's kind of Twilight Zone, right? Because we want a strong economy and people making more money and not, eating top ramen, all that stuff. So good news for inflation, probably bad news from like a long-term health and home ownership standpoint, right? And I think you could see this kind of tale of two economies playing out if you look at a lot of this macro data, right? Because on the left, if you look at like aggregate statistics, total income generated by the U.S. economy, last year we made almost $25 trillion in income. This economy is a powerhouse. It's creating more income than at any point in time ever in aggregate, though. Right? And I think that's because you have certain people at the very high end of the income spectrum who work in remotable jobs, who really didn't, skip a beat during the pandemic, that own homes, that own stocks, that own Bitcoin, right? Whatever, that are doing better than ever. And then you've got the people who are staring down the barrel of $35 packs of bacon at the grocery store, making $55,000 a year, and they're starting to get up against it. And if you look at the right-hand side, you can see the typical household. The typical wage earner still not back to those pre-pandemic levels, right? So on the one hand, super strong economy, asterisk that it's only for some, right? And that probably explains a lot of the like election stuff that we saw just come down the pike recently as well. See the same thing in spending, right? We got a bunch of stimulus checks back during the shutdown. We spent those on cars and TVs and all that, and then just kept right on spending and have never stopped since then. But if you look at where all of that spending is coming from, increasingly it's going on the credit card, right? So when inflation was 10%, credit card debt was growing by almost 20% because we were paying higher prices and we also doubled the amount of stuff that we were buying, right? That is not sustainable. And although these numbers on the right-hand side, the charge-offs in particular, are still, I would argue, fairly manageable, right? 4.5% last quarter of credit card debt was charged off. But keep in mind, that's the debt that banks are just straight up giving up on, right? That they're like, we're never getting that money back. See ya. 95% is still on time, but those numbers have tripled over the last 2 years, right? And so consumption, 70% of our economy, but it's been 90% of the recovery, right? All of the recovery has come from spending money, buying stuff now in the second wave, going on vacation, bars, restaurants, hotels, all of that stuff, and that will probably come to an end too. Good for inflation, good for rates, right? But having a lot of cash-strapped consumers out there, probably not a net positive when it comes to like being able to take out a mortgage, right? Like those ratios show up when you bought too many 100-inch TVs or your car's got too fancy of rims, right? So the other thing is, again, keeping in mind that the Fed only controls the very short end of the yield curve. Mortgage rates are dictated by the bond market. And if you look at recent guidance, the Fed hasn't changed their stance even after their recent rate cut. They're still talking about basically a 3% Fed funds rate long term, right? So you can argue about when we're going to get there, right? Is it going to come in the first half of next year? Is it going to take 3 years, right? Regardless, whenever that happens, it's a 3% Fed funds rate, meaning that, you know, if you extrapolate that out and add on the time value of money, right, that it's worse to have your money locked up for 10 years than it is to lock it up for 1 day and get it back from the Fed, right? So the Fed sets the floor, but people want to be compensated for opportunity costs, and there's also private sector risk. Loaning me money is worse than loaning the U.S. government money. I can run off to Vegas, I can get hit by a bus, you name it, right? So all that stuff gets added on, and when you add those typical spreads onto a 3% Fed funds rate, it's hard to envision a scenario where we don't have about 5.5% to 6% mortgage rates, right? And guess what? You could have already got that back in July. You don't have to wait till the end of 2025 to get a 5.9% mortgage. You have a lot of sellers, I'll show you in a second with the competitiveness stuff. They're confusing this normal seasonal lull in the housing market for an implosion. They're like, oh, my brother-in-law, right? They're like, he was right. Look, he just sent me this thing that shows less stuff is selling over list. It's like, yeah, that happens every winter, right? But they're going to be motivated to move that house, and it's like they, you know, the buyers should be buying and then refi. Just to hammer this home too, I'm like actually walking the talk. I bought a house and closed on August 5th, and the rate was 7.5%. So if they go down to 5, I'm going to go refi and get myself a new car. Until then, I'm accumulating equity, right? And so that's the name of it's a long-term game. It's not a time the market game. This ain't Bitcoin. You can do that in your Robinhood, right? How does the election play into that? Generally, elections don't matter. If you statistically model out effective elections on housing market, you don't see anything. This time, I think we have the potential for policy to change pretty rapidly, and that will matter. I don't think the election in itself has any impact, and I should preface this by underscoring that these are not like my personal political beliefs, which are completely not relevant. This is through the lens of what it means for the housing market. We're the Realtor Party. We're the Purple Party. We care about what's it going to do to transactions, what's it going to do to home prices, and that's how I'm looking at this. So my personal views do not matter one single bit, but I think there's some things that we can be optimistic about, and also some things where it's not just a slam dunk, Bob's your uncle, sky's the limit, ride the wave housing market as a result, right? On the one hand, I think there's going to be tax cuts of a lot of different flavors. I think we're going to see overall marginal tax rates come down. I think we have the potential to restore some of the stuff that we lost during the last round of tax reform that was particularly impactful for us in California. State and local tax deductions, right, in particular. We pay a lot of property taxes, getting the mortgage interest deduction back. We have a big chunk of our market where people take out mortgages that are bigger than $750,000. And so getting some of that stuff restored, positive, right? I think we also have the potential to get some new stuff that will be positive for the housing market. The capital gains one is big. We've been talking about that for a long time. There's a lot of people who have just lived in their house a long time, and they've appreciated a lot, and they probably don't even like those homes, but now they have to pay this huge capital gains tax bill. It's a big problem on the coast, but you have a lot of that even in the Central Valley as well, because we have a lot of people that bought homes in the 70s, early 80s that still live in those homes. So it's not like just the people in San Francisco or something like that. It's a statewide problem. Getting that through could potentially unlock a huge chunk of inventory. We have about 2.7 million people trapped by capital gains. We estimate that would fall to less than 1 million if we could get this capital gains threshold doubled. Not all 1.7 million of those people are going to move, right? But even if you apply pretty small conservative percentages to 1.7 million people, it ends up being a lot of transactions, right? 10%, 170,000, that's a lot, right? So I think we've got the potential for these first-time homebuyer tax credits. That helps. You got a lot of gainfully employed, high-income renters who don't have a lot of money in the bank that just need that little kind of boost to make that leap into home ownership. I don't know how much I want to like keep splashing in realism, but on that one, I'm like, I love the idea and theory, the way something like that's going to work in California. And I love home ownership, just so you know. I work for the realtors because I like care about home ownership. That's the thing that keeps me here, not like in an investment bank trying to make more money or something. But being real about how that plays out in a market like California, where we're inventory constrained, you pump up buyer demand, and it usually means transferring wealth to sellers because you use that extra money to sweeten the deal and get your offer accepted. You don't just kind of take the windfall of savings, and right? So still be great, though. It will still definitely help, but that's not the silver bullet. We're trying to get some supply stuff in there, too. That's all the positive stuff. The kind of negative is that I'm a little bit more cautious about the glide path now for rates. So on the one hand, we're going to have more money through tax cuts, through restored benefits for homeowners and incentives for home ownership. Over the short run, I think that inflation is going to have an even more incremental progression towards the Fed target. And again, just thinking through the economics of how tax cuts play out, people are going to have more money. They're going to be out there spending that money, right? That's the point of tax cuts. They're going to be buying cars and houses and paying for the bacon and doing all of that stuff. But what did we just learn, right? We're in a very labor-constrained marketplace. And so for the grocery store, for the hotels, for the restaurants to meet that demand, they're going to need to hire more. And we don't have those idle resources, so wages will probably have upward pressure. This is a good thing long term. We want people working and making money, but the reality is that in a full employment economy that you juice up by giving people more money, right? It's the same thing as a tax cut. Prices are going to be a little bit more sticky than they were before. Same thing on the tariff front, right? Like bringing back our productive capacity for manufacturing of different goods is a net positive, but that's a long-term play. Over the short term, it means raising the cost of the stuff that we buy from abroad to make our firms competitive again, right? That means paying more for TVs and computers and cars that are shipped from abroad, right? Having a strong manufacturing base, good. From the standpoint of prices and interest rates over the next 12 months, probably less good, right? And so just thinking through the kind of net effects is that we will have more money in our pockets to spend, balancing that against the cost of the stuff that we buy, which we're more or less dependent on the rest of the world for right now. means that we're also going to be paying more. So putting it all together and trying to assess the net effect is the name of the game, right? I think rates have been the sole and solitary focus of people up to this point. If that remains the case, then you're going to see people probably worried about the interest rate and inflation more. If they're more jazzed about having more money in their pocket, potentially seeing a stock market that loves tax cuts and go up and feeling richer, right? And that starts to, your own kind of personal balance sheet and personal economy starts to matter again, and not these kind of external macroeconomic data points, then it'll probably be a net positive, particularly if the stock market kind of rebounds and booms. It's in a weird spot over the last couple of days, and I think they're both worried about inflation and excited about their tax cuts. So they're kind of in the same boat as me on that, but I think if the stock market rallies, that will be the thing that really tips it to a net positive. Going to be some good stuff and some bad stuff. Unfortunately, it's like the one-armed economist, right? You're getting the two-arm version today because it's on the one hand, but again, on the other hand. And I wish it was a slam dunk. Believe me, I wish we would get tax cuts and precipitously declining rates, and I would tell you to pop the champagne corks. But for now, I think it's nose to the grindstone. The wild card tip in the other way is office. We got 30% vacancy in office. A lot of big haircuts being taken on office space that people are trying to get out from under. If that metastasizes into the stock market, that swings the other way. Then we're not as rich, right? And people don't feel like buying that second home or whatever and getting their horse property in Tehachapi or doing whatever they were going to do before, right? That's how it would show up for us. I know we're mostly residential, but this still matters for us, because it affects the stock market and the wealth effect that would then bleed through into residential and all of that. So those are the reasons why I don't want you to take your foot off the gas. I will say that things have improved, though, right? Like, even though it hasn't been as robust, and if you watched KTLA yesterday morning, you saw me get absolutely destroyed. Like, I don't know what I did to this reporter. But he listened to my podcast, and I said, fool me once, shame on you. Fool me twice, shame on you. They're like, Economist admits to being fooled. But I was expecting a much stronger recovery this year. I made the forecast last October, and through the first 3-4 months of this year, we were right on track. We were 3/4 of the way to where I said we would be at the end of this year in March. Unfortunately, and what I said I got fooled by, I was really just acknowledging that I should have expected the bond market freakouts to continue, is that we had 4 major bond market freakouts. Rates went from 6 to 7.5 to 6.5 to almost 8 to 6 to 7, and buyers got totally scared off of the market. The economy progressed more or less exactly how I said, but the bond market was constantly caught with their hand in the cookie jar, thinking those rate cuts were right around the corner, and every positive piece of news, they jumped ship, rates went up, and then they go, okay, but now this time it's really, then they would come back in and rates would go down, CPI would stay strong, and this is the tail of the tape. Super strong rebound through the first quarter of this year that lost all momentum and plateaued for the entirety of the rest of the year. And so things still got better. Actually, last month, things were up 10% from where we were at this time last year, but we should have already been at 300,000 units right now on the basis of the actual economy, people's incomes, the jobs, long-term prospects for wealth accumulation, all that. Instead, that's what happened. Again, when you look at the state, doesn't really matter where you look, but I'll show you a ton of local data too. It's mostly a macro-driven show. It's about people waiting for rates. That's why I keep saying don't wait for rates. I know it's getting repetitive and annoying to us, but unfortunately hasn't gotten through to the population at large. Southern California is suffering a little bit more than other places, but really you see the story more by price segment than you do geographically, right? When the state as a whole is growing, it's because those high income, that tale of two economies, those very high income, remotable job type people who own stocks and homes are leading the charge. When the market goes up, it's because 1, 2, 3, 5, 10 million shoots through the roof. Even when rates, I didn't bring you all the way back to 2020 and 21, but even when rates were 3%, under 400,000 was still shrinking. I think you'll see that even in the Bakersfield, which I did bring back to 2015. Meanwhile, prices keep going up. We're on our 16th, 17th month in a row of consecutive price increases. So like I was joking that if you want to perfectly time the market and buy at bottom, you got to like find Marty McFly, jump in the DeLorean, punch it to 88, and go back to last fall because you've missed out on a year and a half's worth of price appreciation since then, and that's just the second way that your brother-in-law has led you astray. Not only are home prices growing, right? So these are the growth rates on a year-to-year basis in California median home price. Not only have they been above zero for 16, 17 months in a row, if you look at the tail end, it's reaccelerating, right? It's ramping back up, even at a 6.5%, 7% rate. A lot of pent-up demand expressing itself. What do you think is going to happen when rates start to come down even more, right? We're in a tight market. You take that windfall and add 20 grand to your purchase price because your lender said you could without affecting your mortgage payment, right? So that you get the house. These are going to start growing faster. I'm like, that's the one questionable piece of my forecast is that I didn't bake in enough price growth for next year, but you can see that's already starting to happen. So you're waiting for rates, meanwhile getting left in the dust by prices. If you look at Bakersfield, I'm going to show you all the local data, but in some ways I didn't even have to because we're just a microcosm of everything that's happening in the state. Your amazing AE spent like a lot of time helping me understand the local geography so that I could do something more meaningful than just Bakersfield as a whole, right? These are how we defined areas. You'll have all these slides. In fact, you already have all these slides, so if it's helpful, you can use them, right? But you can see the same thing. Strong couple of years at 3% rates. Rates more than doubled. Sales dropped off a cliff, and we've had a little mini rally this year, but really plateaued as that rate volatility hit there on the right-hand side. So when you add all this stuff up and compare it to all of this stuff from last year, we're up about 3%. Roughly, which is a little bit better than the state as a whole. And I think we're still kind of have our own domestic economy to benefit from. And unlike places like the Bay Area and LA, we're able to peel off housing refugees from those terribly unaffordable places. So we got that kind of double-pronged recipe for success, but we can't escape macro trends either, right? So we're punching above our weight, but not so much so that we can throw it in cruise control. Again, if you look at the city broken out by those regions as defined by your areas, if you squint at that, you can maybe see some kind of a pattern, right? Actually, these are sorted from more affordable to lesser affordable, right, going up the scale. But we actually did have some really good growth during the boom years in markets that were more affordable. But I think what you're not seeing is that it's the top end of every individual market that's really doing well. It's not geographic driven. This is how many of the sales this year are in each one of those areas, right? So, but again, when you look at it by price segment, you really see, I think, the bigger, starker difference. What was really sad and depressing about this chart for me is not just that sales were down, and keep in mind this is only a partial year here, so we expect that to be above 23 once the dust settles on the last 2 months of the year. But what's so depressing for me is like almost all of the market used to be under 300,000 even just 10 years ago, right? So your brother-in-law keeps telling you to time the market. Meanwhile, all of the homes that used to be 200,000 have graduated to 350,000, and all the ones that were 350 have now graduated and become $500,000, $600,000 homes. And this is why you don't wait for rates. You can always get the lower rate in the future. You can't ever go back in time and pay $200,000 for the house, right? So the econ nerds call that a type 1 or a type 2 error. It's like, how do you want to be wrong, right? You want to be wrong in the way that's going to be least harmful if you are wrong, right? That's why we do beyond a reasonable doubt, right? Because you don't want to accidentally lock up somebody for life or execute somebody unless you're really, really sure it's cheaper to go back and execute them later if you find conclusive evidence, right? Like instead of executing innocent people, but that's like, you don't want to be wrong the wrong way. And this, look at how small the market is. I sliced out did I bring that? I thought I did. Yeah, but if you look at the growth by price segment, remember I showed you the sales volume increases by area. if you look at it by price segment, it's much more conclusive, right? The higher you go up the price spectrum, the stronger the market was. So again, this is that tale of two economies, and why I bored you with all that esoteric macroeconomic data is because that's why our housing market looks the way that it is. The homes at the high end are doing well. The ones that are at the low end, the investors, the mom and pop people who own rental properties, the writing's on the wall. We don't have enough housing. You want to own as much property as you can. More people are becoming renters. Owning property is a recipe for success, and the people with the money to do so are buying their own primary residences. But that's why, 8 out of 10 homes used to be under 300,000 10 years ago, right? Now it's, you're lucky you're not even talking about 1 out of 5 now, right? So why do you buy? Because guess what this chart's going to look like 10 years from now? There probably won't even be blue or orange on there, right? Like, you'll be lucky to have still gray. That's why you buy a house. That's why you don't time the market. Number one best time to buy a house, 20 years ago. Number two time, like today, especially because we're sitting in the middle of winter and buyers need to wake up and realize buying in the winter is the best time to buy. Sucks moving over Thanksgiving. Awesome. Saving 30, 40, 50 grand. Prices go down in the winter every year. You're leaving a lot of money on the table. I would print this one out and show it to all these gainfully employed high-income renters that live in Bakersfield and say, point to me the spot on this chart where it made sense for you to wait on the sidelines. Right? Looking back historically. When did it make sense, right? Even in 2022, which is this kind of like, I'm not good with colors, but that one, it's, rates more than doubled, right? We had the fastest increase in interest rates in recorded history. They didn't increase by the most, but they've never tripled in such a short amount of time as they did then. And what happened to prices? They basically went flat, didn't even decline in Bakersfield, right? That's because of our structural issues and why owning real estate is a recipe for success. When you have way too much demand and not enough supply, prices don't go down. Simple as that. Like, there's enough pent-up demand and people making a lot of money that they absorb those rates, and prices in Bakersfield did not decline at all. Doesn't matter what area we're talking about, citywide or any of these sub areas, prices are up. You should have bought 10 years ago. You should buy now, right? Same thing, right? Like this, by waiting just even the last couple of years, right? Look how much more you have to spend now. It's really as simple as that, right? And again, that's across the board, right? Like, none of these are in the negatives when rates tripled. Not one single part of the city went negative on prices, and they're not going to triple again, right? So this idea that you're going to get the foreclosure at $199K again, like we used to in the good old days, not going to happen, right? And prices are still rising exactly because of this chart. This is the number one most depressing chart that I'll ever present. It should be the number one most motivating chart we could ever look at. The reason why prices always only ever go in one direction over the long term is because we have too many people and not enough homes to put them in. If you look at our state now, we've almost doubled from the size that we were in the 1970s. We used to be 20 million people. We're more or less 40 million people today. And yet we build way fewer homes, right? When we were a 20 million person state, we were building 300,000 homes a year. During the 1970s, we built almost 2.2 million homes when 20 million people lived here. In our housing boom years, 2000 to 2009, when we were overbuilding, we had 20 million more people living here, and we built 800,000 fewer homes than we did when there was only 20 million people living here. You don't have to be a mathematician, an economist, a data nerd to draw a straight line from this chart to the 16% housing affordability in California. That's why you buy. That's why you don't time the market. Buy now, buy as much as you can, hold it for as long as you can, and you'll be laughing all the way to the bank because of that, right? Even as rates came down from 8.25 to whatever 6, and then back up to 7 and whatever, housing affordability is still in decline. There's still so many and underhoused people making a boatload of money that it keeps upward pressure on those prices more or less no matter what. And this is one of the major ways that we are distinguished from the rest of the United States. We are incredibly hostile to new development at the government level, at the neighborhood level, right? Like, go build the houses somewhere else. We have a public perception problem where we haven't connected the dots on why our kids all moved to Idaho and all that stuff, right? It's like Phoenix, Arizona isn't nicer than Bakersfield. It's cheaper than Bakersfield, right? Like, so unfortunately, that's the kind of tale of the tape. I'm still optimistic, though. and that's because people still get it. The value of home ownership is still there. That's why I'm not giving up on working for the realtors. This is my, I might go get this tattooed on myself later, like after this, because this is why we do what we do and why I'm so proud to serve you and hopefully give you even some nugget that gets some buyer onto the property ladder. My dad didn't even graduate from high school. And you can draw a straight line from his purchase of that house in 1979, where he's like, why would I pay $350 a month? This is so, this is financial suicide, to me being here doing super like nerdy speed. It wasn't because he had all this formal education and network connections. He owned his own home. I had a roof over my head and food in my stomach, and I could focus on being a spreadsheet nerd, right? Like, that's what's up. And if you take all the people in America, put them in one big pot, line them up poorest to richest, that middle household has 190 grand. But if you separate people out into two separate pots and you put all the owners in one and all the renters in another, the people in that second pot never have any money. They're just as poor now as they've always been. And people will tell you that you can rent, take the extra money and invest it in this, that, or the other and end up better off. We can all do calculations and write stuff down and go through thought experiments and do calculus and stuff and like satisfy our own intellectual curiosity. But the Fed's data shows that that's not what people do, and that's never what they've done. They end up over-consuming, buying more stuff, bigger TV, fancier car, nicer clothes. Home ownership's the one and only way you're going to get ahead in this life. So quit trying to time the market and start reaping the well-documented benefits of home ownership, which are is the only way to do it. We are building more. Most of them are ADUs, right? We can lean into that more because people hate new construction, but ADUs are the least offensive kind of new construction you could do. It's not a 10-story apartment complex, so we got to get there somewhere. And this is one of our success stories. It's also a success story because we did this. The real estate community hammered on this and made it harder for cities to deny ADUs, and lo and behold, people want them and they're building them. So we can make our voices heard, donate to RAF, all that stuff. Insert your favorite thing there. People are still going to move, right? Like, I just sold my house and bought a new one, even though I had a 3% mortgage, and we've all heard about the lock-in effect. Nobody wants to walk away from their sweetheart mortgage rate. You don't want to, but sometimes you have to, right? You have babies, somebody dies, somebody gets a new job that gets transferred to another place. All of these life events are still out there and accumulating. And that's why even though 2/3 of California still has a sub 4% mortgage, sometimes you got a gun to your head and you got to make that move, right? 1.7 million babies is a lot, right? You can't just keep like shoving more and more babies into the closet. And I tried. They started complaining. Once they learn how to talk, it's like, it starts to become annoying, and then so people are still going to move, and in fact, you are seeing that. People are getting divorced. I know that's near and dear, but that's why listings are going up, and we're at the highest levels that we've seen since the pandemic started. It's another great motivator for a buyer, right? Not only are we're in this kind of seasonal lull where the market's not that competitive and you got sellers that are starting to freak out. You also have more options to choose from than you've had this whole time over the last 4 years, right? So options are a good thing, right? The other thing I think that we really need to hammer home is to I was going to say cancel, but I'm even going to go more aggressive and say kill the home buying season. I would love to not have a home buying season. I would love to have no seasonal pattern in the housing market because I think buyers are leaving a lot of money on the table. Every single year you see the same pattern. This is median time on market. What do you see? Lowest in the home buying season, highest in the winter, right? Do you want to buy when it's crowded or right? Do you want to go to Disneyland on a Saturday in July, or do you want to go on a Tuesday in February, right? Like, you don't want to go when there's long lines and all the hotels are booked and expensive, right? That same logic applies to the housing market. Is it inconvenient to move during Thanksgiving? I would argue no, because then you have an excuse to let somebody else do all the cooking and cleaning anyways. But you also probably do yourself a huge favor financially too, right? Not only are they sitting longer, meaning the sellers are motivated, prices tend to be lower. The amount of people that reduce is higher, right? The amount of sellers that are willing to cut you a deal. They're not, in the weeds of housing market data. They don't know that the housing market always softens in the winter. So when their house goes up it's been sitting there for 30 days, when their buddy who sold it in April had it on for only 15, they panic and they start talking rate buy downs and concessions and how you feel about a new roof, right? And like all that stuff, that's good for you as a buyer. And guess what? That's happening right now. 40% roughly of all the actives last week had done a price reduction. So you're waiting for the end of 2025 to get that 6% mortgage rate. That seller will probably get that for you today, right? And you can ride out the next couple of years of price appreciation and have that be money in the bank, not money on your principal balance outstanding when you buy 2 years from now, right? Same thing when you look at and you have more choices, right? You see the same thing in Bakersfield, right? That you actually have a window of opportunity. If you go back to when rates were at 3%, we're talking about an overwhelming amount of the homes are closing above list price, right? Now, you're talking about a third or less across most of Bakersfield going above list. This is your window of opportunity. What do you think is going to happen to these numbers when rates fall a ton? They're going to go up or down? There's going to be more stuff closing above list, right? You could get that rate today. You got more options. And guess what? You're not having to claw your way past all those other people at Disneyland. So, hey, let's get it going. Same thing, right? If you look at it over by price segment, right? Except at the top end of the market's actually getting a little bit more competitive. So if you know somebody who wants that horse property, I probably wouldn't wait for rates to fall a ton. If you got cash to spend, great time to spend cash, right? Because you don't have all those pesky other borrowers out there to compete against. So same thing, days on market, better in the winter, right? So I'm bringing you all this local data. And actually, I told Derek I'm going to send you guys this every month when I update our MLS stuff so that you'll have all these breakouts and days on market, sales over list for all these sub areas. And you'll have these slides too. But the bottom line is don't wait for that 6% rate. You could probably get somebody to get you that right now, particularly as they're over-interpreting the seasonal lull as a seller, right? And so you've got this kind of window of opportunity, especially as the prospects are that prices are only going to get worse as rates come down more, right? In fact, normally prices aren't going up in the winter. I showed you the growth rates on prices that they're reaccelerating, but the actual level of home price. So this isn't just compared to last October. The actual nominal value of homes is getting higher and higher. So the longer you wait, it's not waiting for spring. Prices are already going up in real terms today. So again, if I haven't hit it home, your brother-in-law sucks at math. This is the forecast, 10% increase in transactions. Somebody's like, how could you possibly have a 10% increase in transactions? We're at a very low base, right? 10% is good, but it still only takes us to 304,000. Pre-pandemic, still very long ways off. Some people have to move, but a lot of people really are in love with those mortgages, and so that's the other reason. Tight supply is going to be the rule, not the exception going forward. Even though all these crazy things are subsiding, the grind is going to be real. So just keep your foot on the gas. The market is getting better, but we're going to have to probably keep working harder than ever. We're still at 11, right? All of that stuff, but the price situation's only going to get worse. Amazing time to already have your foot on the property ladder. But again, this just shows you the longer you wait, the worse it is. This is why you buy for the long term. Forget time on the market. If they have a really good realtor, they're going to be in great shape and make a boatload of money. But you guys got to be those great realtors and step up your game and be those trusted advisors. That's the recipe for success. If you do it, sky's the limit. Thanks.
questions for Jordan.
Oh my gosh.
We have microphones too. Can we get a microphone over to these folks?
I have a question. You mentioned you had a podcast.
Yes. Yes. If you go to our website or wherever you do podcasts, it's called the Housing Matters Podcast. Although I'm a bit traumatized now and might watch what I say and be a little bit less informal. That's my brand. Hey, you see what you see is what you get. But yeah, Housing Matters Podcast. We try and do that like very informal and timely. And just that way it's like kind of a place where in the interim between things where we can say, oh my God, you see this thing in the newspaper or the Fed just did this, and keep it very like current event focused.
One of the charts you had an acronym SALT.
Yes, thank you for calling me out on that. I am a data nerd and speak only in acronyms. SALT is state and local taxes. So part of the 2016 or 2017 tax reform, one of the things that hurt California was a capping of the deductibility of state and local taxes. So you used to be able to deduct your state and local taxes with the premise being that you're not supposed to get double taxed, right? So you can deduct the money that you give to California from your federal taxes so that you're not getting taxed on money that you got taxed on. They capped that at $10,000. In most other parts of the country, that's enough. But we have both a very hyper-progressive personal income tax regime in California, meaning that we have a lot of people paying more than $10,000 just in state income tax, and that doesn't count property taxes. So like effectively what it meant was that a lot of people weren't even allowed to deduct their full property tax anymore and can't deduct any of their state income taxes. So, you know, for those people paying $15,000 a month, assuming they're in like a 30-ish% marginal, that's $5-6 a year straight to the chin in terms of just less money back in your pocket. So if we get that back, that's money back in your pocket that you can now use to pay these mortgage rates. Yeah.
Corporations are making a lot more sense now. Any more questions?
Jordan, will you describe to them where they can see your snapshot that we get every couple weeks?
Yeah. If you go to our website, C.A.R.org, there's a place. Hey, I'm going to get in trouble at work, but there's like a lot of labels at the top. Ours is Industry 360. If you click on that, there's a ton of market data there. We actually do a weekly wrap-up. One of the kind of byproducts of the craziness of the COVID times is that instead of going into every MLS in the state once a month and summarizing the monthly statistics, we started pulling every MLS in the state every single day, and we've created a weekly market report. It's like, and there was no constraints on me, so it's like 150 pages, but it literally has like every possible stat you could ever want, like week by week, and it goes right up through Saturday. So like right now, if you went and downloaded it today, it's through Saturday the 15th or whatever that day was. We have like days on market, sales. We break it out by region, by price segment. We have sales over list. Every like nerdy rabbit hole I wanted to go down, I was able to, and now it's just growing. But you have a write-up on that as well. We turn it into just a one-page infographic so that you can share it. We do monthly infographics for Bakersfield and Kern County and like 500 other cities across the state. Going forward monthly, I'm going to email Derek all of those sub-area charts that you just saw here. I program that in. So every month when we process the data, you'll have those too. And if there's something that you want that's not on there or that you can't find, I'm like always shopping for my next project. And almost all of my great ideas came from you all, so which I'm happy to take credit for. But let me know. Holler at your boy, and I'll make something if it's helpful.
Actually, what I was talking about, we get a weekly update from C.A.R.
Oh, yeah.
And the last screen, I mean, it's only little short updates. And the last screen, if you track it, like we went this week to 400,000 as a median. Last time it published, it was at 403. The time before that, it was 404. The time before that, it was 395. So you can see by a weekly snapshot, and
It's
it
happening
really
in
is a
real time.
one-page snapshot
Yeah.
how our market is faring.
Yes, and that's in the same exact place too. I have so much stuff. I'm happy to be able to peddle my wares. Thank you for that question.
Valerie.
You had mentioned like a type 1 or type 2 error.
Yeah.
Economic terms. I forget what slide I'm okay. Can you elaborate on that?
Yeah, I know. I knew the death penalty reference analogy wasn't going to land. I should have known better. Yeah, like the idea of how do you want to be wrong? So if you listen to your brother-in-law and wait for rates and he's wrong, right, and rates don't go down, now you're paying a higher price at basically the same rate or maybe even a higher rate, right? If you listen to me and you buy now and I'm wrong and rates do plummet to 4%, well, you've gained a year or 2 years worth of equity accumulation and you lost nothing because you went out and refied and got the lower rate anyway. You can always get the lower rate in the future. You can never go back and get the lower price. And that is kind of the distinction, like you're trading off, right? Because prices, because of those structural issues, they're going to go up and down with the economy and there's crazy stuff that happens and they go up and down. But if you zoom out, not just look at it month to month, but look at it over the course of years, prices only ever go up. And so you can be confident that, like, even the people that freaked out, right? Like, there's a lot of people in 2006, 7, 8 who, I forget what the Bakersfield price was back then. I don't think I even brought that long of a history, but like, they were freaked out that prices were going to tank. They maybe didn't even lose their job, but they saw these foreclosures and whatever, and maybe prices went up to 400,000 and then dropped back down to 200,000. They go, you know what? Forget this. I'm out of here, right? Foreclosed on those, walked away. Those homes are probably 500, 600. I know in San Francisco, I don't know the Bakersfield number, but I know in San Francisco, a lot of people foreclosed when prices went from 900,000 to 600,000, and prices in San Francisco this year were about 1.8 million. So hanging on and finding a way to beg, borrow, and steal to keep that house going, even suffering through the worst housing collapse in recorded history, you'd be net positive by about $1 million right now. And if you would have waited to time the market like your brother-in-law said, you'd be facing a 1.7 million, right? So that's the logic. It's like, if I'm wrong, I've cost you nothing. If your brother-in-law is wrong, you may not ever become a homeowner. That's the, yeah.
Nice. Any more questions? Jordan, thank you for coming today. Appreciate it.